Thank you very much. Thank you. It's a pleasure to be here. For those of you who aren't familiar with Deterra, we're a diversified resources royalty company. So Randy and Scott talked a bit about the business model more generally, but clearly from a streaming perspective and with a bit more focus on a particular commodity. So from our perspective, we're looking to bring what's been a very successful business model in other parts of the world, and particularly in North America, to ASX. We're listed on ASX and have been since late 2020. And with a market capitalisation of about $2 billion Australian, we're part of the ASX 200. We have a portfolio of royalty and royalty-like assets that sit across a range of commodities, as we just heard, with a core focus on iron ore, but broadly a focus on bulk base and battery metals. So we're not focused on precious metals in the same way that Randy and his company are, and many of our peers. We're looking to do something similar, but across different commodities, delivering the same benefits that the business model brings. We have substantial cash generation capability, and in fact, in the 4.5 years or so since we listed in late 2020, we've generated a little bit under $1 billion Australian of revenue. Consistent with the model, which is a very light, scalable and very light overhead model, we tend to operate at very strong earnings margins. So historically, we've reported earning margins in the mid-95%, EBITDA margins in the mid-95% range. And you can see on the chart here up on the left-hand side of the chart, that causes those revenues to flow through pretty directly into earnings. We heard a bit about the business model, but to be clear, it is really a very simple and compelling investment thesis. We provide our investors with top-line exposure to mining, but with very little exposure to operating expenditure or capital expenditure, and what is in effect an option or a free carry into extension or expansion of underlying mines. We have a mix of high-quality cash-generating assets and good quality development assets that support our shareholder returns. And we have a consistent and patient and disciplined approach to creating additional value by adding further investment opportunities into the portfolio. It's worth perhaps just talking a little bit more about the royalty and streaming model, and the economics are similar, although there are important differences. To be clear, we are much more focused on royalties than we are on streams. So a royalty operates, as I'm sure you're all very familiar, essentially it gives you a slice or a piece of the top-line revenue of a mine. And in doing so, it provides a way to invest in mining with some key structural advantages. And in particular, as a royalty holder, you get exposed to underlying commodity price, you get exposed to the production volumes that are coming out of mines, but you don't have exposure to operating expenditure, you don't have exposure to margins, you don't have exposure to capital costs and other elements that go along with operating a business. So it's a financial interest rather than an operating interest. That protects you against cost inflation, and in fact, cost inflation can sometimes be a positive factor. To the extent that cost inflation is reflected in higher prices, that will be reflected in higher royalty payments. I mentioned, that the other really core component is that as a royalty holder, where you have a right to receive revenues over output from a mine, to the extent that the miner is expending in expansion activity or is investing in extension of mine life, you get to benefit from that expenditure without having to contribute to it. So it gives you that optionality upside along with that cost protection. As I mentioned, we have a portfolio of a number of different royalty and royalty-like assets. We have two key assets. One is a gross royalty, a gross revenue royalty that we hold over BHP's Mining Area C operation in the Pilbara in Western Australia. That's our foundational asset and really the asset around which the business was established and around which we're looking to build out the portfolio. I'll talk a bit more about that in detail. The other flagship asset we have is an asset that we acquired last year, which is a gross revenue royalty over the Thacker Pass lithium project in Nevada. And again, I'll talk a little bit more to that in a moment. As you can see from the charts, we have, we are still very heavily weighted in exposure from a revenue perspective to iron ore through that Mining Area C royalty, but we also have exposure to other commodities from a revenue basis and also from a valuation perspective. Across the portfolio, you can see we have assets sort of globally in Australia, North America, South America, and some in Africa. But the majority of the portfolio is located in North America or Australia, so good quality geographic exposure. I mentioned the Mining Area C royalty. As I said, that's really the core asset around which our business was founded. For those of you who aren't familiar with Mining Area C, it's one of the 4 iron ore hubs that BHP operates in the Pilbara as part of their Pilbara iron ore system. It's the largest one of those 4. And in fact, following the recent completion of the South Flank expansion at the mine, it's now the largest iron ore operation in the world. It has an annual capacity of 145 million tonnes a year, which, to put that in context, that's about 9% of the total global seaborne iron ore trade each year. So very, very large operation. It's long life. BHP's talked about operation there continuing into the late 2040s or early 2050s. And in fact, in some of its filings, its EPA filings, it's talked about operations going potentially as long as 2070. You can see again up on the left there, we've got a little chart that shows the royalty area. That's the polygon in the orange outline. To be clear, we're entitled to a revenue over any product that comes out of there. All the blobs on the right-hand side of that map are the current operating mines. The ones on the left are other deposits that have been identified but are not currently being developed. So there is still some further optionality in the asset itself, in that if those deposits ever are developed by BHP and its partners, we would continue to earn royalties from it. We have a 1.232% gross revenue royalty, so we're entitled to 1.232% of FOB Aussie dollar denominated revenue out of the mine. There's also a second leg to it in that we actually receive. I mentioned before about how as a royalty holder, you're not on the hook for any capital that goes into expansion. In fact, the nature of this royalty is that we get paid to the extent that BHP expands production. So there's a capacity payment that pays us $1 million Australian for every 1 million tonne increase in annual production. That's a ratchet effect. So as production, if it gets over the high water mark from previous years, we're entitled to further payments. So another nice little element to the royalty arrangement. So look, I never get tired of saying this. This is a really world-class royalty asset. If it's not the best royalty asset in public ownership out there, it's certainly one of the top 2 or 3. It is over a world-class deposit in a world-class mining jurisdiction operated by the world's largest miner. It's got multi-decades of life ahead of it. It's got potential expansion or extension potential at some point down the road, and it is generating a lot of cash for us. So in the last full financial year, this asset alone generated about $240 million Australian of revenue for us. So a very, very high quality asset. As I said, that was the foundation asset on which the business was really built, but clearly an important part of the business model is to expand out our portfolio and build around that core asset. In that regard, I touched on sort of the breadth of assets we have, but the other asset that I'd just like to highlight this morning is an asset we acquired last year. We closed on this acquisition in September last year, and it is another gross revenue royalty, and it's over the Lithium Americas General Motors Thacker Pass project in northern Nevada. Now, we really like this asset because we see that it has a number of Mining Area C royalty-like characteristics. It's a very large deposit. It's long life, it's in a good mining jurisdiction, and it's very well supported by its operators and customers. So again, perhaps to put that, to put a little bit more meat on the bones in that regard, it is Lithium Americas describe it as the world's largest non-lithium reserve. It has a very long life ahead of it. In fact, in January this year, Lithium Americas put out an updated 43101 technical report that outlined an 85-year mine life. It outlined a production plan that has significant optionality and expansion potential. A phase one that of 40,000 tonnes a year of battery-grade lithium carbonate, going up through 4 phases of expansion to 160,000 tonnes a year. Obviously, in a great mining jurisdiction in North America, it is, and to be clear, it's not in production, but it is fully funded. In many ways, as a royalty holder, it's done absolutely everything we could ask of it from a royalty. So in the period since we acquired it last September, we've seen over $3 billion US of funding close on this project. We've seen the updated 43101 that I mentioned that doubled the mine life and the production output. And then just a couple of days ago, Lithium Americas and General Motors, who has a project-level interest in the project as well as offtake, announced they'd reached final investment decision. So this project's now in construction. It's expected to begin production in late 2027. So given the scale of this project and its longevity, we see this as being a really important contributor to our portfolio for many, many years to come. As I said, an important part of the business model is to continue to invest, to continue to add high-quality assets to our portfolio. And we have a consistent and patient and disciplined approach in that regard. As I said, we're a little bit different from many of our peers in that we don't focus on the precious metal space. Randy and his company and others do that very well, so we don't look to compete head-to-head in that space. We are focused on a different commodity suite. So we're focused on bulk, base, battery, and electrification commodities. The other key point of difference, certainly in that space, outside of the precious space, an important point of difference for us is our ability to be able to invest at a meaningful scale. So that cash flow generation that I talked about provides us with the liquidity to be able to invest at a meaningful level. So we're looking for investments in that sort of $100 to $300 million Australian range, so call it 60 to 200 US. Which, as I said, is quite an important point of difference outside of the precious metals players. We look for those opportunities either through acquiring existing royalties that maybe they're held by a non-natural owner, or it may be from time to time there are consolidation opportunities that might come along, or similar to how Randy described it as well, by serving as a source of capital for miners, whether they're looking to invest in their own operations, get a project built, so sort of a traditional project finance role, or whether it's about balance sheet repair, or whether it's to support mining M&A activity itself. So as I said, we certainly have the appetite to continue to grow our portfolio, and we have the capacity to do so through the liquidity that we generate. And in that regard, our capital management framework is designed to support both that further investment, but also balance that with returns to our shareholders. And we have, our capital management framework is one in which we look to, we're targeting a minimum payout ratio of 50% of our earnings, and then sort of subject to our needs around investment and balance sheet repair. So we recently, in February, we announced our interim dividend for the first half of FY25 at 9 cents per share. That's about a 75% payout ratio. So we're looking to grow the business while at the same time looking to really return capital to our investors. So we're almost out of time, so maybe just to wrap up, as I said, it's a very powerful business model. We're bringing it to the ASX, and we're doing that through having a really high-quality portfolio of royalty assets. We give our investors that top-line exposure to a world-class iron ore operation, a world-class lithium project that's in development, and are looking to expand upon and build that portfolio. So Look, thank you very much. And I think I'm out of time, so I'll just wrap up there. Thank you.